I want to introduce our next session, and David True, who was, if you were here yesterday, you'll know David True is the old friend of the conference and head of partner PayGility Advisors and NIPay, which is the Payments Association in New York. And he's going to take us through a range of startups and innovators during the day. And speaking of one of those, I just want to tell you, if we didn't mention already, it was probably in an email, is that one of our innovators is VIA, and they've organized which is a ride-sharing facility here in New York. I think they've just made an announcement with the yellow cabs too. And they've got a special deal for the summit. So download their rideshare app. I think it's VIA rideshare app on Android and Apple stores, and type in the codes DFS via New York if you, if you're a new user, or just DFS via if you're a user, you get a discount. I think the rides are between $4 and $5 based on those codes, and you get $10 free. So it's up to you. But you'll hear from Via a bit later in the next session. But over to David True.
Hi guys, it's good to see you guys again. We have a lot to run through today. Am I on?
Yeah, you're good.
Yeah, good. We have a lot to run through today, so there will be a fairly brisk 6 minutes per, and then a little transition time. Fantastic information. I'm looking forward to hearing from these firms. And because we've got such a packed agenda of firms to go through in the next couple hours, I'm going to kick it off right now. This one is on lending innovators, and the first firm is Tala. Unfortunately, Shivani, who is the CEO, could not make it in, so we've got Sam Stein.
Siegel.
Sam Spiegel, excuse me, Sam Spiegel, I'm sorry, protective vote. Didn't get that up on the thing. So Sam, you can start from here, you can stand up at the podium, just hit it.
Sure. I don't have a deck, I'm just going to speak to you guys. My name is Sam Siegel. I'm Chief of Staff to the CEO at Tala. Shivani sends her regrets that she cannot be here today. She just returned from the Philippines. Tala is a mobile technology and data science company that provides financial access, choice, and control to underserved customers in emerging markets. The problem that we're dealing with is that there are over 2 billion people in the emerging markets who are underserved by the existing financial services infrastructure. They are overlooked by the banks, and they don't really have sources of capital that they can use, or other types of financial services. However, as happens with every problem, there are opportunities that arise as well. Mobile money is very much on the rise throughout the emerging markets. Worldwide already, there are over 500 million mobile money accounts, which has enabled people in emerging markets to send and receive funds. And as we know, smartphone adoption and use globally, but also in the emerging markets, has exploded recently. Shivani Sirota, who's our founder and CEO, recognized both of these things, both the problem and the opportunity, when she was working with the UN Population Fund. As part of her work, she traveled across Africa and Asia and interviewed thousands of customers who were overlooked by the financial system. She understood their financial lives, and she came to see that these people were creditworthy, that these people did understand their financial lives, but they didn't have a means to access financial services. In short, they didn't have a financial identity. So armed by this realization, Shivani founded Tala. Tala's aim is to provide financial identities and financial services to these people. We're currently, our largest market is in Kenya. We've been lending in Kenya for over 2 years. We are able to provide credit scores and instant credit in under 5 minutes to our customers. In the last 2 years, we've dispersed around $90 million in originations. We recently passed our 2 millionth loan in Kenya. But just as importantly, even though our portfolio is doing well, thankfully, we've also really helped unlock that trust from our customers. These are people, when we speak to them, they refer to us as their friend and as their guide, and they trust in us, and they value this newfound identity that they have. So that is incredibly valuable to us. We've also launched in the Philippines and in Tanzania, and we're looking to launch in other countries in the coming months. As with any company, especially startups, we faced our own set of challenges too. For example, in Kenya, M-Pesa, which is the dominant mobile money provider, is almost universally adopted. It has widespread use, and that's not the case in every country. There are not these closed loop mobile money systems. For example, in the Philippines, over 90% of the economy is cash-based there. So that was a challenge for us when we rolled out our product there. But we learned quickly that in order to integrate into people's lives, we had to understand how they spent money, how they received funds, how they dispersed funds. And once we learned that, we were able to pretty seamlessly integrate into these people's lives. So I guess the takeaways from this, since we're trying to keep it under 6 minutes.
You're doing good. You're doing really good.
Thank you. There are a few. I mean, there are a couple of generic takeaways that are critical for any startup. First of all, know your customer. Get out there, interview them, analyze all the data you have that's available about them, speak to other businesses that are trying to cater to them to understand the challenges that they face. And second, don't be afraid to experiment, obviously, to solve those challenges. We're constantly trying new things and failing until something hits how we can, in order to find ways to service these people. And then the third thing, which we think is unique to Tala, but it's really not. It's unique to any company that is mission-oriented and is trying to serve a purpose, is even though we're a mobile technology company, even though we're a data science company, at the end of the day, we're trying to solve a human issue, which is our customers feel completely overlooked. They feel like they have not been empowered. And the problem that we're trying to solve, and with a lot of our customers, the problem that we have solved, is that they're not acting reactively, they're acting proactively, they're acting from a position of strength. So that shift in mindset has been critical. And to us, yes, financial identity is important, credit score, and our credit product is important, but that mindset shift is just as important to Tala. Thank you.
Excellent. Thank you very, very much. Yeah, I was, one of the fun things about being in this role is I do a little digging. You can say I was rushing around a bit a moment ago, and it's just a pleasure to be here and have all these interesting firms come up, and because that's an idea that I'm fascinated by, and I didn't even know of the firm until Leon asked me to run this. So anyway, the next one, now we're going to a different kind of lending, an asset-based lender providing revolving lines of credit. Did I get that right?
You did.
Good, I got it off the website. So we got Lynn Chua.
Chua.
Okay, I wouldn't try to pronounce that one. Anyway, Lynn will be up in a moment once we got our presentation up.
Sure.
And a lot of this was put together fairly rapidly. I think we just got the presentation a few minutes ago. So
It's just like being in a startup.
yeah,
So.
exactly, rushing around all the time, which you can talk to.
Sure. What is this next? Got it. Can I take out the mic?
Yeah.
I don't want to break anything here.
Just slide that.
Okay. Hi. It's always fun being the right after lunch talk. I know how everyone's feeling. But I'm here to tell you about Internex Capital. We all know and we've all heard about how lending isn't really occurring for a chunk of the market, particularly the smaller guys, the consumers, the students, these small businesses. So there's a lot of fintech lenders out there, and why are we different? And what we try to do at Internex is really focus on a segment of the market that we think really has been ignored by the rest of the marketplace lenders, alt-fi lenders, P2P lenders, fintech lenders, whatever names you choose to call it. And we are focusing on the lower mid-market. And let me just take you into the lives of a small business, not your mom and pop shop. We're talking about lower mid-market. We're talking about the trucking companies, the janitorial services, the wholesalers out there. So what happens at the end of the month, and what do they care about the most when you're a small business? Money. How do you get money to pay for your employees? How do you get money to pay for that increase in supplies that you want to have, but you can't to increase your sales? And more importantly, how do you fuel the engine that's really going to make your business grow? So what we do is we come in and we bring asset-based lending. Yes, liquidity is a commodity. That's not unusual. But what's unusual is the technology that we drive through it. Again, back to that small business. Imagine it at the end of the month. The clerk is sitting there trying to match invoices against sales of its customers to try to work out how much money it's got. If they can scramble to get there, they figure out at the end of the month how much cash they have in the bank. At the same time, they're turning to their bank if it's available, a super high interest rate lender if the bank is not going to be there, which is predominantly the case. And they're trying to work out, well, now how much will you lend me? And in that tight period of time, many of them fail. So for us, let's change the experience to Internex, where what we wanted to do was to give them a bank-like experience, where through our technology, we integrate with their systems, we integrate with their bank accounts, so that on the one screen, our customers can see what their cash position looks like. The clerk is no longer required to do the matching. Our algorithms and our APIs match it against their invoices and their cash. We tell them what their cash position is. And on the same side of that screen, on the other side of that screen, we use our asset-based underwriting models to tell them on demand how much money they can draw down for us. They press a button, they get their cash the same day and the next business day. So that's what we want to bring to the table. Flip on the other side of our investors, our creditors. Why are we different? And maybe this is back to the point on your ask that we talk about the journey. So I'm an ex-GE Capital person. I've spent 20 years in financial services. And when we were sitting there looking at all the lending that we're doing, frankly, at a lot of the lending that we're doing also post the crisis, we saw a huge chunk of the market that we couldn't tap, that we couldn't help in any way. And this is the low and mid-market. And so our vision was to take the GE Capital rigor that we have in underwriting, in asset-based writing that we were very comfortable with in the mid-market space, take it downstream, drive technology through it to give my customers a very, very different experience, but maintain that underwriting rigor. And also, through that integration and that technology, I, as the lender, get to see and have better visibility and better manage them. So together now, I'm able to help my customers, allow them to manage their cash, and on my side, I now use asset-based lending. It is groundbreaking in fintech lending. It's not really done. Why? Because it's labor-intensive. It takes a lot of expertise, and technology allows us to overcome a lot of that and take it to a lower mid-market. So our roadmap, very quickly, we formed the company 2 years ago, but in how we thought we were going to be different, that was the typical way of starting a startup is to bootstrap it, start it out of a garage, lend a little bit on a spreadsheet, and go from there. We took a different philosophy, in part because we were lucky that we had strong GE Capital partnerships behind us. So we partnered with parties that wanted to be with us day one. So we spent a year just building our infrastructure with the help of these partners that funded and supported us. And in addition to that, we got dry capital, we got dry powder, and started lending at the beginning of this year. So we're still very, very early in terms of lending, but then we spent 2 years building it, and we're very excited about it. So in terms of the challenges that we've had to go through and overcome during all this period of time, first of all, we knew we had the right people. We had put in place really cutting-edge technology, which, by the way, we knew we didn't want to have a GE Capital person for that because we wanted someone that wasn't used to the big budgets of the banks. We wanted someone that was used to being nimble and agile. So we found a 4-time, basically, entrepreneur and got him in to join us. So really to mix the old and the new together in an industry that we think requires both a mix of the old and the new, not just the new and the new. And with that, what are the challenges we face today? It is very, very tempting as a lender to just focus on volume growth. And that's because that's how people think about valuation of an early stage company. It's about how fast you grow. And as a lender, I would say there's 2 things you gotta do for lending. 1, you gotta lend the money. 2, you actually have to get that money back. And we focus on that. We focus on lending smartly and carefully. And we focus on making sure we keep the old, which is the rigor in our underwriting, and the new, which is the agility, the nimbleness, that we have as a startup to put together something that we hope can really help fuel the growth of small businesses in the lower mid-market in the United States.
Bingo. You hit it right on the nose. Excellent. The problem with sitting up here is it's actually hard for me to turn around and see what's being presented. So anyway, if we're going to move to our next panel then, which is labeled as Privacy, Transit, and Underwriting Innovators. Unfortunately, one of the participants, one of the panelists, Dimitri Sirota, was not able to make it in today. But we can sort of transition now. And at the end of these 2 sessions, there will be questions. We're going to have questions at the end of the 2 sessions? Yeah. So after the next panel, then we'll have a set of questions. Okay? So that's a transition. You can go back and sit down. We'll have questions for everyone at the end.
Sounds good.
Again, this is the volume structure to get through a lot of people. So Dimitri's not going to be there. Is Mark? Mark Stein? Mark is here. Yeah, I saw you, Mark. You just. And I know we have Saar. And I think that's it here. Okay, good. Yeah, I think that's it. That's what I've got on my list. Oh, Jake. Jake. Is Jake here?
I have slides. I have
Jake?
slides.
So there was someone who sent me a note earlier.
I don't remember.
This is like Bueller. So Jake. Okay. Oh, here's Jake. Jake's here. I knew he was in the building because he sent me an email. So we got 3 out of 4, which is pretty good. And in the interest, so we're going to queue up the folks who have their presentations.
I'm gonna try.
Yeah. How many of y'all have presentations today?
I brought one, but
You
I'm
brought
not gonna
one?
use it. No.
Jake, did you bring one?
Nope.
Okay, good. So we're cool. So I don't think we have any for this.
Cool.
Did you want to use?
I do, yeah.
Okay, good. Saar has one. Do you have one
So
for
do you know
Saar?
the name of yours?
It is, let's see, it starts with today's date.
None of them have the date.
2017-06-09 something. It ends with my name.
None of them. Did you change it?
No, I just put a name on the front.
I got nothing.
When it was an email it over, because he's going at the end and see if we can get it. Yeah. So we're going to do a little mechanics here to email that over, and then after we get that done, we'll get started.
Let me forward this.
Forward it to-
Go ahead.
He's got your email address?
No, I'll talk to him
Okay,
offline.
good. All right, good. So I think while he is preparing or forwarding the materials, we will move to Mark.
All right. Do you mind if I just sit here?
Yeah,
and
you
do
can sit
this?
here and
This
do
is more- I'm going to be lazy, and this is more comfortable. My name is Mark Stein. I am the founder and CEO of Underwrite.ai, which sounds more impressive than it actually is, because I'm also the CTO and the janitor. So, but this is about my 9th startup, so I've kind of been through this before. And the way that I generally approach startups, and this is not as a suggestion that others follow this path, but you know, it's provided me with an entertaining path, which is I don't start a company and then look for a product to sell. I find problems that interest me, and I see if I can solve those problems. And my presumption is if I can solve a problem that hasn't been solved before, then there will be other people who will pay me to solve the same problem. And what I was working on, this is about 3 years ago, was solving the problem of prostate cancer diagnosis. And I know that's kind of off stream, but the basic problem with prostate cancer diagnosis is it starts with a PSA antigen test, which is quite imprecise, about a 70% efficacy. So lots of false positives, lots of false negatives. And if somebody shows elevated PSA, they get scheduled for a biopsy. And what the biopsy consists of is basically sticking a fine needle into the prostate and taking a core sample. And they'll take a few samples and then send it to a pathologist who will look to see if he can find a tumor. Well, if you realize the size of the prostate and the size of the fine needle, you realize, well, the problem is you're probably not going to hit the tumor. So you often have situations where people get scheduled for as many as 7 different biopsies to try to hit a tumor.
Ouch.
Yeah, this is not fun. We won't go into the details of how they do these biopsies, but trust me, it's not fun. It's also very imprecise, and when you get this sample and you give it to a skilled pathologist, there's a 70% efficacy in their diagnosis. Right? So my question was, well, what if we looked at this a different way? What if instead of demanding that we hit a tumor, we looked to see if we could determine from the healthy tissue in the prostate whether there's a tumor nearby or not? And that the way that we could do that is by looking at the gene expression within the healthy tissue. And could we correlate elevations in certain genes with the probability of cancer? And that actually worked very well. It has significant efficacy. But when I started thinking about how do I, productize that, well, the FDA has, what they consider a fast track for a laboratory-specific diagnostic exam. But it would still take me, I'd have to raise $100 million, and it would take me between 3 and 7 years to get approval. Right? But I come from a background in financial services, so I thought, well, why not why not see if there's some application in this? Because the problem that we were solving was how do you address a nonlinear problem like cancer genomics? And we need to apply a nonlinear solution. And that's what I was building. Credit is the same situation, consumer credit particularly. You know, there's been a lot of discussion here about the unbanked, the underserved. And my interest was, well, why are people underserved, right? We've created a credit structure in the United States, and it's even worse outside the United States, in which we've divided the population into three cohorts. We have people who have FICO scores above 700. Is that time remaining?
Yep.
Oh, I better speed up. FICO scores above.
It's good when he's sitting next to me.
Yeah, thank you. 700 who have access to cheap credit. We have people with FICO scores below 700 who have access to expensive credit. And we have people with no FICO scores who have access to no credit. In a developing country, you know, in India, a very small percentage of the population actually has a bureau at Sibyl. They're the rich people. They have credit. People who don't have access, who don't have received credit, haven't received credit in the past, don't have credit. So the question was, could we take the learnings from genomics and learnings that we also had from particle physics and apply it to the problem of consumer credit? And so I built a mechanism for taking a bureau that would be able to effectively underwrite across the spectrum of people who would otherwise be declined. And then we started working with alternative bureau data because we could also underwrite people who are thin file and don't have FICO scores. And we found that that was the real breakthrough. We went to work with a subprime lender that had a 32.8% first payment default rate and correspondingly high interest rates. By building a nonlinear model and looking at 2,400 attributes instead of looking at 4, we were able to reduce that default rate to 22 in the first month. But then, by injecting performance data back into the model, we brought it down to 18% the next month, then 15, then 12, then 10, then 8.6.
Yeah, keep going.
So we then
finish it up.
found that, okay, well, this works. This works in deep subprime. Can we apply it to small business lending? Can we apply it to private placement corporate? You know, by building nonlinear models based upon financial ratios of publicly traded companies. And we found, oh, lo and behold, it works just as well. And the answer is, what I compare it to, if I'll take one more minute, is that okay?
30 seconds.
30 seconds, is weather. Weather is the ultimate nonlinear problem. You can predict weather with linear technologies, but you can only predict it in the short term. You can predict 3 days or even 10 days. You cannot predict 6 months. Credit is very similar. When you look at the market as, you know, bifurcated with FICO, you've got this pool that's readily predictable and this pool that's much harder to predict. And that's the space that we're working on, and that's the problem we're solving.
Excellent. Thank you very much.
Thank you.
So now we've got Saar's presentation up, and Saar Gold from VIA. And many of us know VIA. I'm looking forward to hearing this because I know of VIA, but I haven't yet actually taken a ride with them, so I think I'll have to do that.
Thanks. So I'm Saar. I'm the chief data scientist at VIA. And what? Oh,
Closer to the
sorry.
mic, or hold
So I'm Saar. I'm the chief data scientist at VIA. And what we do at VIA is we're re-engineering urban transit. What does it actually mean? So we're building a software that operates a network of on-demand shuttles. You can think about it as kind of a bus line that goes exactly to where you need to go, and the buses are actually small SUVs, so they're very convenient. The way it works is that you request a ride from point A to point B, and we send a vehicle to pick you up at a street corner close to point A, drop you off at a street corner close to point B. You can think of those as kind of your virtual bus stops. The app tells you where to stop, and the vehicle that picks you up might actually have other people in the car, might pick up and drop off other people along the way, but it doesn't make big detours, so it actually goes exactly to where you want to go. So that allows us, so basically what we have is an on-demand transportation system that's very, very convenient. It goes to where you want to go. It's shared, and it's fully dynamic. So it responds to changes in demand. It responds to changes in traffic. We take all of those things into account. We solve this very complex dynamic traveling salesperson problem in real time in order to do the routing that's needed to happen. A little bit about the company. So right now we operate ourselves as a consumer business in New York, Chicago, and DC, and we have over 700,000 users. We've done over 14 million rides, and last month in New York we've done over 1 million rides. So there are some parts of the city where we're bigger than Uber. So we can say that we are the first on-demand shuttle that operates at scale. Shared rides is all we do. You never get your own vehicle to yourself. We also offer our technology as a platform. So we have a couple of partners around the world and here in the US. Public transit agencies, for example, like in Austin, where we've replaced a defunct bus line with a dynamic route, basically small shuttle buses instead of a fixed bus line serving at low frequency. We have service in Paris. We partnered with Paris's largest black car company, and now they offer shared ride services using our technology. We have similar arrangements in England and coming soon in other places. We've raised a bunch of money, but the thing we're really, really proud of is that we're way more efficient than any of our competitors, meaning that we also help reduce congestion and help and reduce environmental effect. Because we do shared rides, the more demand there is during peak hours, the more efficient we are. So the net effect of taking a via ride is actually a negative net effect on overall congestion in the city. So in order to answer some of the additional questions that we had, for those I don't actually have slides, so we can kind of potentially ignore that. So the origin of the idea actually came from kind of some similar concepts that exist around the world, but are not dynamic. So in Israel, there's something called Shirut taxis, which are taxis that go along kind of somewhat fixed lines, but no fixed schedule, and they just stop, they drop off people along the way, they pick up people along the way, and you can just wave to them and they come stop, and pick you up. There are similar things in Peru, in Lebanon, in all sorts of other places. So the two founders thought about taking basically this concept, pairing it up with actually being able to not only do the dynamic pickup locations along the route, but opening it up to complete open pickup locations, drop-off locations, and real-time routing. It's a very, very hard problem to solve technically, but if you have the right people and the right algorithms, you can actually solve that. So that's what we did. So pain points along the journey, it's an interesting problem. There were quite a few, especially explaining the vision to different stakeholders early on. So think about 2013, the company was just started. Uber was not anywhere near as big as it is, and they only thought about shared rides like Uber Pool a little bit after they saw us growing so fast in New York. So thinking about that and explaining it to people was actually fairly hard. If you're trying to get a fleet owner that you're trying to contract with to get drivers from, and tell him that there is an app that tells the driver where to go, there's an app that tells that riders actually request rides on, and it all works, and it sends the cars dynamically to people, the fleet owner kind of just like looks at you because his experience is that it's really hard to install Excel on your computer, and he has to get his cousin to do it for you. So fleet owners, it was hard to find fleet owners initially to buy into that. When you think about kind of investors and stuff like that, they usually think about things that scale that are kind of almost pure software. You have a lot of control over, and this is basically an operational nightmare, so they never thought that you'd be able to get fleet owner to buy in and to get and to serve riders, and at the end there's a driver that needs to take a left turn and maybe there's a car blocking the turn. So that was So that was a challenge, at least the beginning. Obviously, it's no longer that big of a challenge. People now know what it is, and we do kind of 250,000 rides only in New York every week. People say regulation is kind of hard. We actually, unlike some of our competitors, we actually work really well with regulators. So even though we have to comply to all sorts of things, it's interesting. But it's in some cases, because of our attitude towards regulation, it actually is somewhat of an advantage. The big thing is that this is a very, very competitive market. It's a huge market, but it's very, very competitive. So that sometimes proves out to be kind of a challenge. In terms of successes and failures, it's a bit early to talk about successes and failures, right? It would sound a bit cocky to say, hey, we've made it, because no one has so far. But we're still here. In some parts of the city, we're bigger than Uber. In some, and so, you know, everything can change, and some of our competitors are very, very well funded. So that's, but on the other hand, we're making it pretty well. We're very careful. We haven't actually rolled back any type of service that we've launched, so maybe we're too careful. That's an interesting point to think about. And the other thing is that it turns out that working with partners is actually a lot more complex than we thought. We thought we'd just license our technology and people would just run with it, but it turns out that over time we built a lot of operational knowledge on how to run a transportation system at a city scale. And it turns out that that's also something, it's not enough to just license the technology and let people run their own operation. We have to help them because that just, otherwise it doesn't work that well. Takeaways and lessons. I think the first one is that the people are actually the really important asset that you have at a startup. And it goes both for technical resources. You have those kind of like 10x programmers that can build something. You have this mathematician that can build, that can solve the traveling salesperson problem in real time dynamically. You have things like that, or a data scientist that can actually predict what a driver will do tomorrow morning if offered something. You have, operationally, you have people who can, if you hire overqualified people, especially in a company that grows as fast, they can grow into new roles and get more. So people are really, really important. Culture is really, really important. More than for our competitors, I guess. But also because we license our technology,
that
right?
was definitely done.
But the thing is, we license our technology, right? So the city of Austin is letting us run some of their bus lines, and I don't know if anyone would let Travis run their MTA, right? It's like it's an actual thing that affects not just how the company operates, but it actually helps you operationally. And I think the last thing is balance. It's really, really important to strike the right balance between kind of staying the course when something changes and realizing that something fundamentally changed, so you need to change course yourself. Between being very data-driven, and one of my roles as a data scientist is to kind of provide the infrastructure for everyone in the company to do their analysis, but the balance between being data-driven and having analysis paralysis. So balance is a really, really, really hard thing. And maybe the last one is that you need to do kind of things that don't scale, and which is really important when you're kind of working on systems that involve people, right? It might be that someone out there is complaining about something, no one else is complaining about that. You're already doing 250,000 rides a week, but we still look at each and every complaint because we do find problems with our service that a lot of people feel, but only a few people complain about, and that's kind of a real way to improve. So that holds to, again, you have to kind of keep the balance and not look at everything all the time. You'll get stuck, but that's another kind of thing. Do things that scale really badly.
Thank you very much. You got through the presentation and through the list of points we wanted you to cover, so that's good. It only took a little longer. So thanks very much, Saar. And hold all these in your head, because after the next one, we'll have a chance for some questions. So I know there's a range of firms, but we've allotted some time after this too. So now we're going to have Jake come up. Jake's over at Rollio.
Do you want me to come up or sit here?
Whatever you want to do. You're just talking, right? Or did you?
Yep, just talk. I'll just sit here.
Yeah, rock and roll.
Easy too. Hey everybody, I'm Jake, the founder and CEO of Rollio, and our our story really starts a few years ago when I was doing a summer internship at an early stage incubator / VC fund called Acceleprise Ventures. And there were 3 partners. I was the intern, and we used Salesforce as our CRM with 3 partners and 1 intern. I'll give you all one guess who was actually entering the data into the CRM. I was. They had more important things to do. And I quickly realized this really cool job and role I thought I had. Half of it was just being a data entry jockey. And if you've ever used a CRM, you know that it sucks. So
They do.
So I sat back and asked a pretty simple question. What if we could talk to our CRM the way we talk to people? Pretty strange question, but we thought it was a great idea, pitched it to the incubator I was at, and they actually invested in it. So following that summer, went to RPI, where I started my freshman year, used our small investment, and built what was Rollio. Gave it to a bunch of customers. We built this product that we thought was awesome based off a bunch of assumptions, and no one liked it. It was awful. First thing we learned is don't assume what your customers want. They will call you stupid. So from there, we kind of sat back and questioned, how do we rebuild this? We have no money. And a mentor of mine, Eric Koester, who is the founder of Zarly, said one of the greatest pieces of mentorship advice I've ever heard. Everybody's heard the saying, you don't need any money to build a startup. And we say, okay, what does that actually mean? He said, act as the technology. So I literally locked myself in my dorm room for a week, took a bunch of texts and calls from salespeople that were willing to do that, and said, give me your Salesforce login, I will enter the data for you. They loved it. At the end of the week, they said, can you keep doing this? I said, no, I need to go back to class. So after that, we validated it, which was huge. Just that piece of validation, the references were enough to get people excited. We went to the RPI business competition, won some money to rebuild this. The 3 of us who originally started it, a bunch of AI nerds, sat in our dorm room, crunched all that data that we got from the original testing, and built a small pilot, which we then showed to the president of SAP. President of SAP CEC, Carsten Thoma, founder of Hybris. He loved it. Before this whole chatbot wave, he said, I get what you guys are doing. Data entry is terrible. CRMs, they're just a commodity. It's a database with a fresh coat of paint. No one likes using it. In fact, we did a little bit of research on it to help pitch to these investors, and we found that only 40% of Salesforce users or CRM users update all of their activities. So 6 out of 10 licenses that companies pay for are just going in the garbage. That's millions of dollars for big companies like Cisco Systems or SAP or I don't know, Oracle, whoever's using CRM with huge sales and service teams. So he got it, invested in us, and this time we did little builds. Gave it to a customer, and we knew they weren't going to like it. We knew they were going to hate it and said, it doesn't work, it keeps breaking, it doesn't scale, it's slow. But that was the best part, because they helped us build our product. When we first assumed the features, assumed what it should look like, how it should flow, we got nowhere. So just by listening to them is really how we built this and has helped scale it and sell it to customers just like them, fitting that profile. I think, am I up?
No, time is up. No, we got a Q&A. I guess we got a Q&A after this. Well, you get a minute to wrap? You can wrap really quickly if you need.
I think that's
cool. Well, I want to play with it. I want to see, because
Yeah, for sure.
I've suffered through the indignities and the uncomfort of having to use
fun.
Salesforce. So yeah, let's play with it. Anyway, we've got a Q&A. We've got 5 firms, I think, to ask about. So any questions over the folks who come up over the last 2 sessions?
Hi, I'm a question I'll ask Saar about VIA. So how you going to be, they have a customer basis and also you have driver basis, fleet. How you can make them the same time simultaneously coming to your platform?
So, I mean, it's 2 different sets of stakeholders. We get drivers from where you get drivers, and we get riders mostly by word of mouth. So far, we haven't invested a lot in marketing, mostly because in most of our markets, getting drivers is a lot harder. So we keep our kind of rider growth organic, and we work on getting drivers on board. If they're using, classic marketing thing from digital to bus tails that you can see here in New York to going to where drivers are, which is the JFK parking lot mostly, for example, here in New York, to all sorts of things like that. We're a startup, we're scrappy. We can find drivers wherever they are and sign them up, explain to them how it works. There's radio stations and blogs that cater to drivers, stuff like that. We are doing a lot of personalized marketing on the rider side, but with a very, very tiny budget, just so that when it comes time to turn it on, we're ready.
Got one over here?
Yes, just a question for Lynn at Internex. How is your solution different than invoice financing and some of the fintechs in that space, Fundbox and others? It sounds like that's what you guys are offering.
So, can I be heard?
Yes.
Really?
Yes.
Okay.
Hello.
What was the gentleman that asked the question? Sorry, I just lost him. I think without wanting to get it too technical, but we provide a revolving line of credit. So we truly are a bankable, if you wish, solution. So a borrower that comes to us integrates their system with us and their bank accounts. And so I provide on an ongoing basis a dynamic facility with a dynamic borrowing base so they can keep on drawing with us. So I have a 1 full year facility. I don't do spot factoring. I hope that's enough information. I'm happy to give you more information and detail if you'd like.
I actually had a follow-on question to that. So when you say integrate with their systems, does that mean you get to see the receivables and payables and all that, and based on that? Okay.
Correct.
I got it.
Which is why for us, really we see technology as doing 3 things for us as a company. The first one is the customer experience, because they no longer have to deal with the painful task of managing their receivables and their cash and their collections in the old way. That's one. And secondly, from a reporting burden perspective, where typically for this type of facility with a bank, our borrowers are sending a lot of information, sending a lot of data, and then the bank underwrites them and gives them information in their borrowing base at the end of the month, right after the company having scrambled to get the data together. For us, we're integrated and we pull everything live. So now on an ongoing day-to-day basis, they literally have a read of where their cash is and what they can borrow and draw down immediately. So that integration is very, very key to their experience. And then flip it over to my side. I have a better pulse on where my customer is. If you're looking at a small business lender, right? I have a pulse on how their receivables are performing, and I have a pulse on how my customer, their APs are performing.
In a way, it'd be a variation of what some folks are doing with credit card lending, based on the credit card receivables.
Correct, but that's cash flow and mine is
cash flow.
asset
Use
based.
asset
That's the
based.
big
I gotcha,
difference,
yeah.
right?
But still tapping into the system and seeing real time.
Correct.
Other questions for any of them?
Yeah, Len, quick question.
Sure.
Your funding source, what is the funding source? Hi, what is your funding source?
Yep. Well, so if I think about funding, I'm going to segregate, if you wish, money that I lend to my borrowers and money that I use to pay the light bills, right, operating expense.
I was saying funding for your borrowers.
Funding for my borrowers, we secured a $100 million line in September last year from 400 Capital. It's a $1.5 billion structured credit fund. And I'm en route right now to, I have 7 banks that I'm in discussions with on a potential bank senior facility as well alongside that.
Question back here.
I have a question for you too. So clearly you have a lot of information about your customers.
Correct.
That is integrating in. Maybe you have access to the bank accounts directly also.
Correct.
So they're trusting you with that. So what percentage of your spend are you spending on security?
That's a really good question, by the way. It's something that I'd say, in part because of the type of people we are, being XG Capital, we were pretty geeky about that. And we felt in the beginning when we wanted to start doing something like this, we really couldn't bootstrap it. And we needed to get the right funding to help us put together a platform. So our partner on the technology front is Genpact. You might know them. They're a spin-off of GE in the old days, so we know them very, very well. And so we have really adopted the security protocols that we've had both from GE Capital as well as Genpact in the equation. So in terms of the dollar amount, I think it's really quite integrated into our entire tech spend. So I can't give you a precise number, but security right down to the policies and IT security that we have. And data security is a very big part of what we play and how we run the business.
Hi, I'm Joel Patton, and I've got a quick question for Mark and Lynn. Both of you described businesses that address underserved portions of the market, and I'm wondering if the data requirements and some of the other aspects of your business are limited to U.S. markets, or if your approaches might be possible in other markets and emerging markets. Thanks.
Yeah, in our case, we're working in a wide range of markets. We've just entered into working relationships in the UK, in Mexico, in Colombia. We're starting to work with people in India as well, and other undeveloped countries like Canada. Basically, I mean, what we're focused on is that there is a different set of available data in each market. In some markets, like we're doing work in Kenya, we don't have bureaus, right? So we're dealing with data that comes like Tala does from cell phones. We're talking to a gentleman here about Philippines, in which bureau penetration is very low. Basically, we have a mechanism for dealing with local data and then correlating that local data to outcomes and building a structure by which we then inject performance data into the model and continuously retrain the machine learning models. So we build nonlinear models, but they're also dynamic models. And it doesn't really matter what the data is, as long as we have valid data, and that's why we look for validated third-party data or validated financials in something like the SMB space.
So I guess on my front, in terms of, if you wish, taking the technology and our data internationally, that's, if I understand that to be your question, I will start off by saying that when we started the business, we really took the perspective that the market segment that we had in the United States was adequately big enough, that there was big enough nut for us to kind of conquer. We estimate that there's $116 billion of potential opportunity in the segment that we're going after. And with that in mind, my business partner and I were the two main co-founders. We actually both have done global financing in our time at GE Capital. So we're very comfortable with going internationally, but we took the view that we wanted to focus ourselves, right, on really just getting the US market first. That being said, I have been pleasantly surprised in the last 2-3 months as we've been getting out there to the market much more, that when I think about my next round of equity financing, I've been getting interest from overseas money. So clearly there is a growing awareness of what we're doing and also a growing interest in portability of our product. So I'll say basically I'm in the early innings of figuring out whether we need to move that timeline forward and think bigger about what we can do internationally, or perhaps we still want to stay focused on just targeting the US market for now.
Other questions? I actually went for, if no one else has one, I went for Sam. Because there was a question about, we talked a little bit about underwriting. So in the cases that you have with Tala, how do you actually assess the risk?
So we use smartphone data to underwrite our customers. These are people who don't have documented financial identities. So they, for some of them, we can go to a credit bureau and pull information on them, but that's not the base of our underwriting. We ask them for permission to access their smartphone data. Once they give it to us, we provide them with an instant credit score, and if they qualify, instant credit. Does that answer your question?
Yeah, that does. I figured it out similarly. Anything more? Please.
Various markets that you're in overseas, have you noticed any differences in terms of the repayment culture between countries?
It's a great question. It's a little hard to distinguish between repayment culture and the means by which you can repay. So, as I alluded to earlier, in Kenya, mobile money is pervasive, and it's very easy to send and receive funds. In the Philippines, it's very cash-based. So it takes a little bit more work to disperse and collect those funds. It doesn't necessarily mean that culturally there is more of a proclivity in one country to repay than in the other, but the means by which you do that vary pretty drastically, which can kind of cloud, the conclusions that you make in terms of answering your question.
You good?
Yeah, hello. I'm Niloco. Question to Jake.
Yes.
Your solution is tied to the CRM. I mean, that's the genesis of your problem. Have you looking ahead, where else do you see that kind of solution being applied?
Yeah, so that's a great question, and actually one that we didn't even think of. One of our investors asked us, you guys realize what you built. You figured out a way to take any unstructured data, or what we like to call dark data, and structure it to a form. So being said, think of everywhere you fill out a form or a piece of paperwork. You walk into a hospital, you fill out a form. A lot of those records are wrong or go missing. You work at Walmart and you want to change your shift. They have terrible scheduling issues. It's actually a major problem right now because a lot of those people, may be dealing with very clunky admin panels where it's difficult to change shifts. They're just not built for an organic and natural customer experience. So now we can make that conversational, where you can send a text, hey, I'm sick, I need to skip my shift. Or I'm coming into the doctor's office today, I have a sore throat and a fever, whatever that may be, and that form is filled out. Not only are we making it a whole lot easier to get that data, we take everything that's valuable and meaningful and put it into appropriate field in a form or structure if there's a place for it. So they're collecting a whole lot more as well. So there's tons of applications where data is either missing or there's just too many barriers to make it actually productive and doable.
We got one last one. We're just at the end, but I know Deb will ask a very succinct question.
Yes, I'm very excited about VIA. I already downloaded it, but I can't tell from the app price.
So most of our rides, rides in Manhattan between 6 a.m. and 8 p.m., anywhere under or anywhere below 125th Street, are $5 flat fee. At night, it changes. If you go out to Brooklyn, if you go out to the airports, it's different. But right now, our prices are basically $5 flat fee anywhere in Manhattan during daytime. It's easy. You can look up, and I don't remember the exact price. It's cheaper than a cab. It's cheaper than the competition. If I remember correctly, LaGuardia is like 29 or something. I don't exactly remember.
Yeah, I think so. I think that was one. I want to thank everyone who's talked and asked questions. It's been a great set of panels. We've got a break for about 10 minutes, I believe, for some conversation and something to drink, and then we'll get back for another set of startups. Thank you. Thank you very much.